And it wasn't, we weren't bullish on gold because of just a Ukraine-Russia conflict. We were bullish on gold because of the fear of ongoing geopolitical confrontations. And then on top of that, a Fed at that time, January, that was extremely hawkish. And we felt that could not get more hawkish than they were. The thing is, gold has been proven not to be, an all the time inflation hedge. And I mean, I think it's the lead up is really where the question can become. So, gold rallied in August 2020, as monetary policy was just to become there was a deluge of free money that was coming out, and the market had, sniffed out the direction that we were heading.
Let's finish up on gold. Gold, all right, we're up a little bit today. Let's call it flat. I wouldn't call today's move a rally, but we're close to $2,000. We're at $19.93 as we speak right now, an ounce. When is it going to sustain that $2,000 level? I'm not talking about just touching it for a few hours and coming back down. When is it going to reach $2,000 and sustain that level? I'm getting old just waiting for this breakout, Bill.
Yeah, you're right. It ran into 2080 on was it Tuesday, and it's pulled back pretty significantly. And it's just an ever-present reminder, if you're looking for a free lunch and you're chasing these massive moves, whether it's crude oil, gold, or wheat, or some of the other commodities out there, you're going to get run over. And that's the clear thing out there. So what I've been looking for, and I mean, I think there was definitely some good trades to the downside yesterday, short-term wise. But what I'm looking for is in 1980 is a big level of support in gold. I don't know if that holds or not. Silver, 2580 is a big level in silver. I don't know if that holds or not. And if it does, I think then the path to breaking out is going to happen much sooner. But I'm prepared for some lower levels that we've highlighted for our clients, and being able to capitalize on it, and looking for overall a longer term move here, because at the end of the day, we came into this year very bullish on gold, and we weren't bullish on gold because of just a Ukraine-Russia conflict. We were bullish on gold because of the fear of ongoing geopolitical confrontations. And then on top of that, a Fed at that time, January, that was extremely hawkish. So we felt that could not get more hawkish than they were. They could only become ultimately less hawkish or dovish. And at the end of the day, we've seen gold bottom at the onset or early stages of a rate hike cycle. So 1979, gold went 4x after rate hikes were kicked off. And I think it was 2004, gold bottomed in April 2004 before rate hikes started in June of 2004. And 2016, gold bottomed the day after the first liftoff. So these are times that you want to be allocated to gold, and I'm using, you can only pray for a pullback right here in order to find even better levels to be buying. Now, with that said, we want to see pullbacks hold very good construction in order to be able to build and not bring damage to the overall tape in order to stop a breakout.
Does it surprise you at all that maybe gold is not as high as it could have been? Take a look at where gold was at 2 years ago. Just slightly higher than current levels. I'm just saying that inflation has breached 40-year highs, much higher than it was 2 years ago when gold was at $2,000. So in theory, if you consider gold an inflation hedge, shouldn't gold be trading at higher levels than 2 years ago when inflation was much lower back then? Does that make sense, theoretically speaking?
Well, you're right, theoretically in many ways, but the thing is, gold has been proven not to be, an all the time inflation hedge. And I mean, I think it's the lead up is really where the question can become. So, gold rallied in August 2020, as monetary policy was just to become there was a deluge of free money that was coming out, and the market had, sniffed out the direction that we were heading. But here's the problem, even though the US dollar has remained pretty weak, the rise in U.S. Treasury yields has held back rallies of gold over the last year. But the thing about that rise in U.S. Treasury yields is that other major sovereign debt, such as the German Bund, remained in negative territory during that time. So the flows, I think, really hindered real flows from U.S. dollar to Europe. So if the German Bund can hold in positive territory this year, in positive yielding territory this year, I think that's going to help gold actually become a real inflation hedge a bit more than it has in the past. So that's something I'm looking at as a bellwether for a sustained move in gold this year.
Okay, so let's sum up. For the audience here, your favorite asset out of all the asset classes that we've discussed today, gold, stocks, Bitcoin, oil, the energy sector overall, which of these is your favorite for this year, for the remainder of this year?
It'd be tough to say, even though I've been as bullish energy as it possibly could have been for the last 18 months. And even new accounts that I'm bringing in on my wealth side, it's tough to really fully allocate them into energy at this time. I mean, a lot of these people are either bringing me fresh cash that hasn't been involved in the market, or coming from advisors that had absolutely no energy and materials exposure at all over the past year. So so it's tough to say I'm as most bullish on energy as I can be, outperforming from here. I do think, though, that I would not be surprised one bit if from this day forward, energy does outperform through the rest of the year. But from a risk reward standpoint, I do think that we're going to see a turn in the market. And I think what could surprise is tech at this point. Now, there's not a lot of, there's no actual technicals that are saying that tech is the weakest link out there. But when it has the most negativity, is really when you want to be buying. And, so to speak, it's a loose term, obviously, given, the war and everything that's taking place right now. And so, want to be wise in saying it, but you buy when there's blood in the streets, and tech has been the most beaten down sector. So it really is, a place that I think there's the most value and the most risk versus reward at these levels.